Let's talk about the feeling you get after a really good week. Maybe you've nailed 3 4 trades in a row. The P&L is green. That tension in your shoulders? It's gone. You're sitting back in your chair. Maybe you even closed the charts a little early. You feel sharp, in control. You figured something out. That feeling is the most dangerous thing in your trading career. Welcome back to Losing Trader Psychology. I'm not here to ruin a good vibe. I'm here to make sure that good vibe doesn't turn into the thing that dismantles your account piece by piece. Today, we're going to dissect the anatomy of overconfidence. We're not talking about the loud, bragging trader. That's just insecurity with a megaphone. We're talking about the quiet, insidious version that grows in you, in me, after a taste of success. The version that whispers, the rules are for other people. Here are 5 signs that whisper is getting louder. The first sign is the most fundamental, and it's where the rot starts. Your trading plan stops being your constitution and becomes a list of suggestions. You created this plan in a state of clarity. You backtested it. You wrote down your entry criteria, your exact risk per trade, your profit targets. It was your rulebook. Overconfidence begins the moment you think, I know better than the version of me that wrote this. It doesn't look like tearing up the plan. It's subtler. It's seeing a setup that's almost your pattern. Maybe it's missing one confirming indicator. And you hear that voice. It's close enough. The momentum is strong. I can feel it. So you click buy. You've just made your first amendment to your constitution based on a feeling. Or it's with position size. Your rule says never risk more than 1%. But this setup, it looks so perfect. So you go to 2%. Just this once. Because this time it's different. You're not following a system anymore. You're following a narrative. A story you're telling yourself about this particular trade. The plan was built for all trades, for the cold, hard average. Overconfidence makes you believe you're above the average. You're not trading the market anymore. You're trading your own conviction. And the market has zero respect for your conviction. Ask yourself this, and be brutally honest. When you took your last few trades, could you point to the exact line in your plan that justified them? Or were you roughly in the neighborhood, hoping the rules would catch up with your genius? Sign number 2. This is about the story you tell yourself after the trade closes. You host an internal awards ceremony for every win and a grand jury for every loss. When the trade goes green and you take profit, the narrative is all about your brilliant analysis, your impeccable timing, your eagle-eyed read of the order flow. You are the hero of that story. But when the trade hits your stop loss, the script flips. Suddenly, it was unexpected news. It was a market maker hunt. It was low liquidity. It was your cat walking on the keyboard. Anything other than the possibility that your analysis was simply wrong. Psychologists call this self-serving bias. It's our brain's desperate attempt to protect our ego. Winning is personal skill. Losing is external circumstance. The moment you buy into this completely, you stop learning. You become a collector of trophies and excuses, not a collector of data. If every loss is a freak event, what is there to review? To improve? You're inoculating yourself against feedback. The market is trying to teach you with every red trade, but overconfidence puts its hands over its ears and says, la la la, I can't hear you. It was the Fed's fault. The antidote isn't to beat yourself up. It's to force a neutral narrative. Say to yourself, the trade hit my profit target. My plan captured a move. Good process. And for the loss, the trade hit my stop loss. The conditions I defined for being wrong were met. What can the chart now tell me that I missed then? This isn't about emotion. It's about forensic accounting for your decisions. Sign 3 is a shift in desire. You start to get bored by base hits, and you become obsessed with hitting home runs. This is a massive psychological shift. When you start out, a clean 1:2 risk-reward win feels fantastic. It's validation. But overconfidence rewires that. Those steady gains start to feel small, slow. You see a meme stock double, or you hear about someone's massive options payout. A quiet voice says, I'm smarter than them. I could do that, but better. So you start looking for the setup that isn't just a trade, it's the trade. The one that will make the month. You start letting winners run way past your logical target, not because the structure supports it, but because you've envisioned a number on the screen. You start eyeing options with far-off expiries and ludicrous leverage, because the potential percentage gain is sexier. You're no longer a gardener tending to a portfolio. You're a prospector digging for a single gold nugget. This is how weeks of disciplined profits get vaporized in one afternoon of heroic, ego-driven speculation. Overconfidence makes you believe you have a special talent for spotting the explosive move before it explodes. You're trading a fantasy, not probabilities. I'll tell you a hard truth. The home run mentality is almost always a form of impatience disguised as ambition. It's the feeling that the steady path is too slow for someone of your obvious talent. It's the market's most effective trap for the recently successful. Sign 4 is the most dangerous, the most direct path to ruin. Your risk management tools start to feel like unnecessary constraints, even insults to your intelligence. This is the logical endpoint of the previous signs. It begins with a mental negotiation. You're in a trade, it goes against you a little. Your stop loss is right there. But you think, that stop is too tight. I said it when I was being cautious. I know this is just a pullback. So you mentally move the stop. You don't even change the order, you just tell yourself you'll get out if it really goes down. You've just switched from automatic rules to discretionary judgment in the heat of the moment, the exact moment your judgment is most impaired. The next stage is averaging down without a pre-planned, structural reason. You buy more as it drops, not because your strategy has a scaling-in rule, but because your conviction that you're right hardens into concrete. You're now fighting the market. You're trying to prove a point. The trade is no longer about making money. It's about being right. Your P&L becomes a scorecard for your ego. This is where overconfidence graduates from a psychological flaw to a financial crisis. One trade, managed this way, can dig a hole so deep it takes months to climb out of. You've dismantled the single most important part of your system, the mechanical, unemotional admission of being wrong. Your stop loss isn't a prediction about the market. It's a budget for being wrong. Overconfidence makes you believe your budget is too big. It makes you believe you don't need a budget. The final sign is a change in posture. You stop listening to the market and you expect it to listen to you. You start to feel a quiet contempt. The price action that doesn't fit your thesis isn't data to analyze. It's wrong. It's dumb. It's manipulated. You find yourself in online forums or chats, not to learn, but to silently judge. Amateur move, you think, scrolling past someone else's analysis. You start to believe there's smart money, you, and dumb money. Everyone else who doesn't see what you see. This is terminal overconfidence. The market is not an opponent to be outsmarted. It's not a student to be taught. It's a mirror. It reflects all available information and all participant psychology back at itself. The moment you think you've decoded it permanently, it changes. Your edge isn't a permanent state of enlightenment. It's a specific, statistical understanding of a repeating pattern under specific conditions. Arrogance makes you blind to changing conditions. It makes you hold a thesis like a dogma. I remember a period where I'd get genuinely angry at the market. Like, shout at the screen angry. That anger was never about the market. It was about the gap between my expectation and reality. My overconfidence had built a castle of how things should be, and the market, by simply existing as it was throwing rocks at my castle. I was defending a fantasy. So, if any of this landed, if you felt a little twinge of recognition, what do? You don't panic. You don't quit. You perform an intervention on yourself. First, you mandate a return to the miniature. For the next 10 trades, I want you to trade half your normal size. Not to make money, to make points. The goal is to execute your plan with surgical precision, with the financial stakes so low they can't trigger your ego. This is physiotherapy for a sprained trading psyche. You're relearning the motions without the weight. Second, you reopen the investigation. Go to your last 5 losing trades. Before you look at the chart, write down the excuse you told yourself when it happened. Then, analyze the chart as if you were a cold-hearted consultant hired to fix someone else's system. Was the entry actually valid? Was the stop logical? Strip the story away. Find the structural flaw, not the villain. Third, you reintroduce the word probability. Say it out loud before every trade. I am taking this trade because it presents a favorable probability, not because I know what will happen. This one phrase is a bullet to the heart of overconfidence. It rehumbles you. It reconnects you to the statistical reality of the game. Confidence in trading is quiet. It's the calm of having a plan and following it, win or lose. Overconfidence is loud. It's the internal noise of narrative, ego, and specialness. One builds an account slowly, sustainably. The other builds a time bomb. Your job is not to be a hero. Your job is to be a diligent, risk-averse processor of opportunities. The moment you feel like a hero is the moment you should be most afraid. If this resonated with you, leave a comment below. Just type, "checking myself," or share one sign you've seen in your own trading. This helps more than you know. It reminds others they're not alone in this mental fight. Subscribe to Losing Traders Psychology if you want to keep doing this difficult work. We're not about flashy gains. We're about building a mind that can survive the market long enough to let compound growth do its work. Thanks for your time. And next time you have a great week, be careful.